What's going on, everybody? Welcome to another episode of Investing 101. Today we're going to talk about a pretty hot topic right now, thanks to the big, beautiful bill in Trump, real estate taxes. Surprisingly, there's actually a lot of people that don't understand the true benefits of real estate when it comes to tax purposes. I talked to a realtor earlier this week, and we were just bullshitting about stuff, and I told him how I was able to write off my commissions because I am licensed, and I was able to write off my commissions because of my losses last year on paper through real estate, and he had no idea what he's talking about. This guy's been a realtor for like 30 years. I'm like, dude, you didn't know you can write off against your taxes if you're a real estate professional? So I thought I'd make an episode about that, kind of just dummy it down for everybody, because I'm not a CPA. I know a lot of investors aren't CPAs. They don't want to talk to their CPAs. They just say, hey, I don't want to pay any taxes. So I don't think that's the way we should go about it. I like to pick my CPA's brain about, hey, what am I doing right? What can I change? What can we utilize? What's trying to take advantage maybe too much? Because you definitely don't want to get audited. Luckily, I have a very conservative CPA. A lot of people will promise you the moon and the world, and then you get audited. And that's not something you want to do, obviously. I don't want to deal with that. I have a ton of transactions. The last thing I want to do is get audited. So he's very conservative, which is why I employ him and why I keep him. But at the same time, he also will educate me when I ask. So it took a lot of time to learn myself just from online and stuff like that, but I wanted to hear it from the horse's mouth. So I'm going to try to break it down to you guys in layman's terms this is the way I interpret it, and I feel like it's going to help you guys, because it can be very confusing about, cost segregations, depreciation, and all that stuff. But you got to remember, tax benefits are one of the four things that you get from real estate. You don't just get monthly cash flow. You got your cash flow, appreciation, depreciation, and amortization, which is the principal paid on. So that depreciation is very big. And with the big beautiful bill that Trump passed, it's huge for real estate investors. So I'm going to go over today just the big beautiful bill of how it affects real estate investors in that way of called bonus depreciation being reinitiated. We're going to go over cost segregation. We're going to go with what is a real estate professional, what is the structuring, how depreciation works, what is depreciation. A lot of people don't understand depreciation. Also the recapture of depreciation, and what happens when you sell, and then also talk about 1031 exchange. So these are all the things that, as a rookie just getting started, or somebody who's has a big portfolio, stuff that you should understand right off the bat to kind of be able to structure your portfolio to really help you. You see a lot of very wealthy CEOs, big high earner, W-2 earners, and then they have their wife be a licensed agent, even though she might not ever do any sales. But since she is considered a real estate professional, they would be able to take rental losses against his W-2 income. So again, there's so many benefits to owning real estate when it comes to taxes. So I'm going to try to break things down for you, like I said, real layman's terms, stuff that helped me understand exactly what they're talking about, and how you kind of can get yourself in trouble. So let's just jump right into it. So first thing, obviously, on the big beautiful bill, he reinitiated what he did in his first term, which was 100% bonus depreciation. So that segues us into what a cost segregation is when it comes to being bonus depreciation. So again, I'm going to try to just lay out the ground rules for depreciation for anybody to understand what it is. Depreciation is basically the deterioration of your property. Now, dirt does not deteriorate. So I'm just going to give you guys an example. I feel like this is the easiest way I learned it. So this is how I'm going to explain it to you guys. So say you buy a property for $1 million and the land is worth $200,000. You obviously can't depreciate the land because the land does not deteriorate. But the government lets you write off 27 and a half years divided by 800,000 per year. You can write that off for 27 and a half years. So whatever 800,000 or the price of your property minus the land, divide that by 27 and a half. That's what they let you take for depreciation. So That's obviously a good chunk of money. You know, if you have a bunch of properties that whatever the purchase price of that property was minus the land, you can get some serious savings from that. But bonus depreciation is huge because yes, you have your deterioration of your property, but when you do a cost segregation study, they'll go in and actually pinpoint, because not everything has the lifespan of 27 and a half years. For example, they have a categories of 5, 7, and 15-year items. An example of a 5-year item would be like your appliances or carpeting. That has a 5-year lifespan. So if you get a cost segregation done, it goes and pinpoints each of those years and tags a year to it. So 27 and a half years might be like the framing. Yeah, your framing will deteriorate over 27 and a half years, but your flooring, your HVAC, your water heaters, those are going to depreciate, and obviously they're not going to last 27 and a half years. So by doing a cost segregation study, anything less than a 20-year schedule, they let you write that off in 1 year. That's what the 100% bonus depreciation does. So if you have a property, and say the total amount of all your items that are 5, 7, and 15 years, anything less than 20, is equal to, say, 20% of your property's value. That's your appliances, like I said, anything that has a 5 or 7, 15-year life. They'll let you write off that whole number year one. That's what bonus depreciation means. So if you have, like I said, say it's 20% of that 800,000, you're going to take that all in 1 year. Instead of having to depreciate it out over 27 and a half years, you can depreciate it all in your first year, which obviously is a huge tax savings. That's the reason why you see some people, they might buy a $1 million commercial property and never even put a tenant in it. And you're like, well, why didn't that guy just do that? Because he had a massive tax bill that he needed to offset. So he bought that $1 million commercial building using financing, only put 20 or 30% down, whatever the case may be. But now he gets the tax savings of that whole cost segregation they did all in 1 year, and he can wipe out $200,000, $300,000, $400,000 in taxes that he would have had to pay just by buying that single property. And guess what? He still owns the property. It's not like that money was gone. He bought an asset that's going to go up in value in time. And that's the reason why real estate kind of went crazy during COVID and stuff like that. And a lot of people think it was the rah-rah stuff, but like why Blackstone and a lot of the big corporations and stuff like that were buying up real estate also was because of that. If you had a massive tax bill, you go buy a couple $1,000,000 worth of real estate, and it doesn't matter if it's leveraged or cash. That's another thing too, because you got to think about it. How can you get that big of a tax break using, so say you owner finance something. Say you owner finance a $3 million commercial real estate property, and then go get a cost segregation done, and that cost segregation lets you write off $600,000 year one against your income. If you negotiated, say, 10% down, you only put $300,000 down, but you were able to save on your tax bill $600,000 from doing one cost segregation study. And yes, there's this thing called recapture. You have to recapture the depreciation if you do sell it. It's at a lower number. I don't know, I think it's like 25%. Every property is going to be different, so obviously you want to get a CPA for something like that. But it's substantially less, one. And two, most of these guys are savvy and they're smart, and they're just going to 1031 it into the next property anyways. So a 1031 exchange would be, if you set that up, they have intermediaries that take care of all of this. So if you have designed property, you can't do this for like your primary residence and stuff like that. Like, it has to be a property that you've owned usually for at least a year as a rental property, and you can take it and you can sell that property and say there's a gain, say you made $100,000 on it or whatever. If you don't touch that money, it goes to an intermediary. They hold the money in escrow. You find another similar real estate property to invest in. You're able to take that money instead of paying taxes on it, since you never touched it, and now you can transport that to the next one. It basically, in layman's terms, it just kicks the tax bill down the road. But at the same time, it saves you. It's a very big way to compound your wealth. Instead of having to pay, say, long-term capital gains tax for you in your bracket is 20-30%, instead of having to give up $30,000 of that 100 grand you made, you're able to take that 30K and roll into the next property, but you're buying a bigger cash flowing asset that's making you more money monthly, and you're not having to give it to the government. So the 1031 exchange is also big. There was talks of that going away. Obviously that's not going away anytime soon as well. So those are the two major things that people are talking about right now, is bonus depreciation being back at 100%, because when Biden came in, they were phasing it out. So they went, it was like 100,000 the first year, 80. Last year it was 60, and this year it was all the way down to 40%. So they're still, and then it was supposed to go away next year, but then Trump kind of reset that, so now it's back to being 100% in the first year. So that's massive tax savings. Next we can jump into real estate professional and what that means. So again, this is, you consult your CPA before you try to claim this status. Obviously, now you have to be doing, I think basically, I think it's like 5,000 hours, something like that. It's your full-time job. That's the layman's terms way to do it. If you're full-time in real estate, as in you're a realtor, you're property management, anything like that, you are considered, in the eyes of the government, a real estate professional. And if you have rental loss or passive income lost, you can write that directly off against your W-2 income. Perfect example, my realtor commissions from last year. Because I had so much depreciation from my property and not showing any profit by having that depreciation and all the other write-offs with real estate, I was able to write off all the money that I would have had to pay for my commissions. I was able to keep, because I took the rental loss that I had from my portfolio, and since I'm a real estate professional, I'm able to now use that against my W-2 income, which, well, not W-2, 1099 income for being a realtor, because I'm a real estate professional. So I was baffled when this realtor did not know that you could do that. I mean, it's a huge tax savings, especially if you're in something like that, or if you're in anything involving real estate and that's your full-time job. Like I said, if you're a property manager, if you're a realtor, if you literally do anything in real estate full-time, you are considered a real estate professional. Again, massive tax savings. If your wife is a realtor, you can now claim real estate professional status. Again, get with the CPA, guys. That is massive for the world of tax savings. So another big tip that I have for people that I get asked a lot because they try to write stuff off, guys, if you're improving your property, it does not count as a write-off one-to-one. So say you have a rental property, tenant moves out, you go in and you replace all the flooring. Say you spend $1,000 to be rough on the flooring. You cannot write off $1,000 that first year as an expense. That flooring has to get depreciated out. And if you're using the correct CPA, that actually will have a year, and then he'll have to divide that year by $1,000, and then you'll be able to write off that much of it. Say it's 10 years and you spend $1,000, that means you could only write off $100 of that flooring you replaced. That's another big misconception. People think, oh, I'll just go spend $40,000 remodeling an apartment building or one of my single family homes and just write off that $40,000. It's not how it works. Now, if you have an expense, think of this. Expense is like a repair. The property needs to be occupied. So anything you do, like with me being a BRRRR investor, anything I do before a tenant moves in is not going to be a repair. It's going to be considered an improvement because it's not making any money at that time. They're improvements. And that obviously goes in effect. It's the same way if someone moves out. It's still an improvement if you replace the flooring, stuff like that, replace the roof. That's not an expense. But say you have like a plumbing leak, say you have a tenant in there and they have a plumbing leak and you have to call CC Plumbing. Now that'll be something that you can deduct the whole expense that year as an expense. Cleaning, landscaping, stuff like that, that's an expense. But anything you're doing to actually improve the property, painting, flooring, appliances, anything like that, is not a one-to-one write-off. Like appliances have a 5-year write-off. So if you go spend $1,200 to go just buy new appliances because you think you need a write-off or whatever, and you spend $1,200 on appliances, you're not going to be able to write off that whole $1,200 all in 1 year. It has to get depreciated out. And that's where a lot of people will mess up. And if the CPA really doesn't know anything, or he's not a real estate CPA, he just thinks, yeah, it's an expense for your rental property. That's got to be an expense. If you ever get audited, yeah, guess who's paying that back? You. So don't believe everything your CPA says, guys. Ask if he's actually like a real estate CPA. Everybody specializes in their own thing. If you're looking for a lawyer and you have criminal charges against you, you're not going to go get a contract lawyer. No, you want a criminal justice lawyer that defends people with criminal records. Like, that's what you want. It's the same thing for CPAs. They're not all really focused on the same thing. Get somebody who's small, even if they're a small business. They have to have some kind of eyes in real estate, and that's how you're going to really protect yourself. One, because anybody can put down on those sheets that, hey, you had this much expenses, and then send it in. And also make sure they're not just preparing your taxes, make sure they're actually submitting them, because this is a little hack that I found, and this is what I was noticing when like other agents, people I used to work with, would tell me who did their taxes. Well, this person would fill out their taxes for them, but they would have the agent sign it and submit it. What does that tell you? They don't want to put their name on it. Do you think that information's right? No, because if they actually submit your taxes for you and you get audited, the CPA also gets audited as well of why that stuff was put there. So there's a difference between a tax preparer or an accountant and somebody who actually will submit and file your taxes for you. You want somebody who's going to file your taxes for you, because then their name goes on it. And at that point, they're not going to do something if they know it's shady. I mean, there's a chance they might just not know. That's what I'm saying. You want to get somebody who's in real estate. That is a very real thing. But if they are in real estate, they'll know this stuff. And if they're not willing to put their name on it, what does that tell you? That means that you're probably going to get audited, and it's not going to go well. So, guys, that's all I got for today. I just want to talk about that because I know that the big beautiful bill was riling up a bunch of people about taxes and stuff like that. And I know a lot of that shit went right over my head when I was first learning. But guys, tax benefits in real estate is huge, huge. So if you need to get some tax break, tax advice, go check out a CPA. Obviously, I'm not a CPA. Don't take any of this for law. Go find a CPA. I tried to explain it the way I learned it, and I interpreted it the best from my CPA. So that's all I got, guys. If you like the content, please subscribe. I've been getting a lot of positive feedback. I love hearing from y'all. Keep shooting me DMs. Any questions you have, catch y'all around.